Hi guys, Jono here from Capital Edge. At Capital Edge, we have a very rigorous research criteria we put into all of our property selection. There's things such as the vacancy rate in the area, the percentage of owner-occupiers, the location to the CBD and to other things that we need in the area, such as restaurants, schools, transport. We look at all that sort of thing, but one of the factors that we look at is called the DSR, which is really important to future growth in an area. The DSR is the demand to supply ratio. The way we work out the demand to supply ratio is I use two websites which are easily accessible, and we're just looking at the demand for property in a suburb versus the supply of property. So if we go across here, realestate.com is our first one we're looking at. So if we look at a suburb like Mount Cotton, here with our filters, we want to look at the house and townhouse because townhouses are in the house market. So we're looking for our supply is how many houses or townhouses are available. And you can see here in Mount Cotton, there's 17. So if you want to buy a house right now, we've got 17 to choose from. Now, that's our supply. The actual demand, I use this website called Your Investment Property Magazine. We can see here, this is a rolling yearly average of how many properties or houses sell in Mount Cotton. So you can see there in April, the average for 12-month period was 187. So this is our demand. 187 people every year want to buy a property in Mount Cotton, whilst our supply is only 17. Now, we're going to go across to the whiteboard and we're going to look at how those two numbers work to form your supply to demand ratio and the reasons why this puts pressure on housing prices if you get it right. The way we calculate the demand to supply ratio is quite simple. If you look across here, we just look at the properties sold on a yearly basis, as I mentioned before, divided by the properties available. So if we look at Leopold and Victoria, there's 263 properties normally sold every year. 29 are currently available for sale, and that's a ratio of 9.07. Now, if we look at demand to supply ratio, a normal ratio of even is if there's say 100 properties for sale, 100 properties that normally are available, that's a 1-to-1, and prices should be pretty flat. Once you get to sort of 1 to 2, 1 to 3, there should be an upturn in prices. 4, 5, 6, really good growth, and if you get to 10, that's known as a boom market, and prices should be soaring. So back here, Leopold, if we've got a property in Leopold, we are laughing. Prices are going crazy. In Rockbank, Victoria, there's currently 45 properties are normally sold every year, but 211 available. So that's a negative DSR score or 0.21. So we don't want to be buying here. Mount Cotton, again, it's 187 properties are normally sold, only 17 on the market. It's an 11, a really good ratio. Redbank Plains in Queensland, we've got 400 properties sold in the last 12 months, 218 available. So 1.8, that's a little bit low for my liking. And just for fun, I looked at Toorak, which is a suburb everyone knows, very wealthy, affluent suburb. We can see the demand supply ratio is 4.7, so there should be good pressure on prices there. We can really use this in our favour. What I want to do is identify suburbs where our DSR score maybe is 1 to 2, 1 to 3, where prices are starting to go up, but it hasn't peaked. The trouble is if we buy into a market, you might say, why don't we buy where the DSR score is 9 or 10? The trouble is we're paying over the odds inflated prices in a red hot market. We want to identify it before it gets that. So what we'll do now is we'll go across the computer and look at how this has impacted each of these suburbs. Now here is the actual proof or data as to this DSR and how it's impacting prices. Mount Cotton, we have a DSR score of, remember, it was 11. So prices, what should they be doing? They should be booming, and they are. And they actually even have down here the DSR score. I don't know how they work out this one. It's probably different to the way I do it, but it's very good, which means prices should be going up. The other places we looked at were Rockbank, where the DSR score was actually in the wrong ratio, and we can see prices are going down. So we don't want to be buying into this market. We've also got Redbank Plains, where it's 1 to 1.8. So you can see it's pretty flat, which is in line with the DSR. Then Leopold, where it's fantastic, and you can see 460,000 the median house price up to 550. We've got a really good gradient. And because of that score, I expect this to keep going for the next 2-3 years at least. And back to Toorak, as we know, is always a performing high-end suburb, which is going up. So I guess what we do at Capital Edge is we use this DSR score to identify potential areas and growth areas that really give us a real understanding of why we're going to get growth just with a simple equation from, high school economics, demand to supply. If you want to hear a bit more about this or have a chat, please give me a call on the 1300 number. Check out our website or our Facebook page, and I look forward to hearing from you soon. Cheers.